Joining us. He's head of India Research and Banks Analyst at UBS Securities India. Vishal, great to have you with us here. Thank you very much for your time. Will the second, because we've got a lot of pre-quarterly updates, etc., and Abhishek, of course, also summarized things here. Will it solidify expectations that this is the one sector which perhaps will make a lot of money going forward? Valuations remain lower than longer-term averages. What really are your expectations broadly, top-down first?
Sure. So I think clearly we are also constructive on the sector. These tailwinds are only become stronger with loan growth coming back in the system. As the last reported data point is around 16% YOY. And the first half generally, which is weak, and historically you saw zero growth in the first half. We have already seen, a 6% plus kind of YTD growth in the first half itself. So that gives us a strong, I would say, base for NII growth and NIM expansion as well. So ideally, I think we are constructive on the sector given the strong tailwinds. Also, when we look at like historically for last, let's say 15, 16 years and multiple cycles, you will see that this kind of environment generally happens, once in 3 to 5 years. And especially coming from a very weak corporate NPL cycle in the last 6-7 years, the system has also delivered. So it's a good backdrop for another upcycle, while I'm sure there are a lot of risks which we can discuss going forward as well.
Right. Vishal, just wanted a couple of data points from you. Among the universe that you track, what has been your expectations of loan growth for this year? You said the first half was an outperformance as against your expectations. And what is the NIM expansion that you're expecting for the universe? And in that, what are the places which stand to benefit more than the average?
Sure. So clearly, when we started the year, we were expecting more like a 12% kind of system growth because there was no real capex-driven growth. Now, as we speak, I think the growth is running at 16%. We feel due to base effect, it will cool off maybe towards 14-15% for this year, but still your average loan growth will still be higher than what we started off with maybe somewhere in March. On margins, I think we are slightly more positive than the street. So most of our estimates on margins are easily 10 basis point higher than the street. We feel the margin tailwinds are multiple. So one is the loan repricing benefit, which is a faster repricing of loan book. But I think more than that, most of the banks are also seeing loan mix shift. And because of a higher retail, higher unsecured portion in their balance sheets, they would get a higher average yield, which will support margins in the next couple of quarters.
What are the risks you were, referring to? Some risks that exist on the horizon for the banking sector. What would they be, and is any of that expected to be factored into this quarter's earnings?
So none of those risks will immediately appear. So the biggest risk I think we have is still the global economic cycle and the interest rate tightening, which we are seeing in the US and outside. The follow-through impact of that, as we've seen historically, could come either in form of exchange rate volatility or excessive tightening in the local economy. So that I think would be the biggest risk to the macroeconomy of India. Also, I think if we look at consensus has been cutting GDP estimates for the next year. So that I think needs to be closely watched because clearly in the next 2-3 quarters, none of this risk will materialize because asset quality wise, there has been like hardly any growth in the system for the last 3-4 years on the loan side.
Vishal, the mortgage financiers, home finance companies, I don't know if you track them. If you do, I mean, is that a good place to be? I'm talking about the smaller ones, not the big boys like HDFC, but there are a bunch of the smaller, very small ticket size loans, Home First and a couple others as well. Is that generally, I mean, mortgages are seen as a safer segment, right? And of course, the runway for growth is also pretty large. What's your view there? I'm only asking that now because we've got a general perception that because as interest rates go up, I mean, it's better to be with large lenders rather than go looking for opportunities in specific niche segments. Go on.
Sure. So we don't cover like the smaller guys. I think But the general comment on overall, again, NBFCs or even mortgages would be the pricing power. If they have the pricing power in terms of increasing interest rates, if they can pass on that to both the existing customers and to the new customers, I think then those businesses wouldn't worry much, because there is a lot of, as you said, there's a structural demand for affordable housing or small ticket housing, so that tailwind of growth can still support those businesses. But the moment we think about larger companies where ability to pass on this higher interest rate is limited, I think generally, again, historically, again, if you go back and see, generally those businesses struggle at the time when the rates are rising, immediately during that period of 1 to 2 years.
These private sector banks, right, they've been growing at the NII growth this time is expected to be about 17, 18, 19% across the board. HDFC, ICICI Bank, Axis Bank is expected to do much better. Is this a sustainable growth run rate that you see for the rest of the year for the private sector banking space?
Yes, we feel that this growth rate of closer to 20% for this, especially the larger private sector banks, would continue. Part of this is coming from loan growth. Also, I think you are seeing margin expansion, which we believe would continue for the rest of this year.
All right. And would you, given the prognosis of improved prospects, look at any of the public sector banks as well, apart from the largest one?
So now on public sector banks, as we have seen multiple times in past, there have been multiple failed starts. So every time, people trying to become bullish on public sector banks, there is something or the other which kept happening. After a almost 7 to 8 year period of cleanup on asset quality, finally their credit costs actually are lower than some of the private sector banks. And there is still room for some of the public sector banks to report lower credit costs. This is generally the environment when one can buy public sector banks. Now these are always a trading stories or tactical buys, not sustainable, because their ROA and capitalization generally are weaker, and that keeps diluting shareholder returns over time. But within a cycle, for a shorter period of time, they tend to outperform for a very, again, depending upon how long the cycle would be. So at this point in time, they are actually better placed, I must say. I mean, we continue to like private sector banks over time because we believe more, structural stories.
Okay, Vishal, we'll leave it at that. Thanks a lot for joining in. So that's UBS Securities with their expectations on the banking sector. And as Abhishek was telling us, this time around it's expected to be a very strong run, especially for the private sector banks. Let's see, for the market, as of now, it's holding up. We have Rashmi Bhatnagar, who is the head of global equities